In today's video, I'll be talking about SMT divergence. There was a video I made where I promised I was going to make a video about SMT divergence. So this is the video. SMT divergence is when you have disagreement between two or three pairs that are supposed to be moving together. Pairs that are positively correlated. Pairs like Nasdaq, S&P 500 and US 30. These three pairs, they move together. When one is making higher highs, the other one is making higher highs as well. So when there is disagreement between the three or between the two, some traders use Nasdaq and S&P 500, but I like using the three of them: US 30, Nasdaq, and S&P 500. When you have disagreement between the three of them, when there is crack in correlation, that is when you have divergence. And basically, we have two types of divergence. We have bullish SMT divergence and bearish SMT divergence. So what divergence does is that it serves as an extra confirmation to your analysis before you take a trade. That is how I use it. If I have made my analysis, if I don't see SMT divergence between these three, I don't take a trade. Let's take for example now. Let's take for example, this is Nasdaq, S&P 500 and US 30. If one is making higher highs, the other ones are making higher highs as well. If they are making lower lows, the two others are still making lower lows. But a situation whereby you have disagreement between the three, that is, if this line, this black line I put on my chart, was supposed to be a resistance, and the three of them, they are approaching a resistance, making higher highs and higher lows. Then on getting to this resistance, if the market wants to turn around, I'll be looking for bearish SMT divergence. How? I will look for some sort of disagreement between the three of them, whereby the two will make higher highs, then one will fail to make a higher high, instead making a lower high. That is disagreement. Normally, the three of them, they were supposed to make higher highs. But if it happens like this, we now have what we call bearish SMT divergence. That is Nasdaq making a higher high, S&P 500 making a higher high, but US 30 making a lower high. So once you see it like this, that is one. Then you wait for market structure shift. This is now the confirmation that the SMT divergence will hold. Look at it. The importance of combining these three is that if a trader that is trading only Nasdaq, when the trader sees this break of structure, the trader will think that the market has broken this resistance without knowing that it is just liquidity grab. So with the help of the three, now with the help of US 30 being this one, we know that these two, they are just liquidity grab. But if you are trading only one, you will think it's break of structure. You will now place a pull limit order here. Later, the market will take you out. This is the importance of using SMT divergence. If you turn this chart around now, it becomes bullish SMT divergence. Let me just go to chart and show you examples. Let me delete all this. I'm on daily time frame, Nasdaq. I want to use, this is Tuesday, no, Friday last week is what I want to use. Look at Friday last week as it closed. Then Friday last week closed, leaving a fair value gap here. Then as I saw this, I marked Friday's low because I was hoping for price to come and mitigate this fair value gap. Then if you go to S&P 500 on daily time frame, look at Friday's low. I'll still put line there. Friday's low. Then if you go to US 30, look at Friday's low. I'll still put line there. So I want you to look at US 30. When Friday closed, there was no fair value gap present in US 30, which shows balanced price action. But if you go to when I showed you Nasdaq, there was fair value gap. So I was hoping that when on Monday, because this was Friday, that on Monday or Tuesday, I was looking for some sort of SMT divergence to confirm continuation of the uptrend. So look at what happened. On Monday, nothing happened. Tuesday failed to take out Friday's low on US 30. But look at what happened on Nasdaq. Look at what Nasdaq did. Tuesday, look at Tuesday. Tuesday took out Friday's low. This is bullish SMT divergence. So if you go to lower time frame, if you go to US 30 on lower time frame, like 1 hour time frame, say if you are, if you are doing your analysis on daily time frame, your confirmation time frame is 1 hour time frame. You can see use 30 minutes, or sometimes I go down as low as 15 minutes time frame. So I was on 1 hour time frame. I was looking at this high to be taken to be broken by price to confirm the SMT divergence. But on 15 minutes time frame, I saw it clearer. Look at 15 minutes time frame. Look at the break of structure or market structure shift, anyone you want to call it. So if actually you wanted to take this trade, after this break of structure, you mark the other block here. If you like, you mark here, or you mark the entire down close candles like this. Then you take your entry here. Put your stop loss. Some will put their stop loss here, but I don't do that. You put your stop loss below this low. Then target anywhere you want to target. Me, I would have targeted here. Look at it. Almost 1 to 3. Okay, 1 to 3. Let's go for 1 to 3 because of this high as well. You understand? So it was massive. It was massive. So this is one example. Let me show you another example. I don't want this video to be too long. Let me go back to daily time frame again to show you another example. This one now happened on Friday. Yes, on Friday last week. Look at it. Let's say this is Tuesday. Okay, Thursday, sorry. If I put Thursday's low, is it Thursday? Yes, Friday. Okay, yes, Thursday. Okay, new week I've already opened. Okay, this is Monday now. We've entered another week. Okay, this was Thursday. Then this is US 30. Let me show you Nasdaq. Nasdaq on Thursday. Look at the low. Yeah, let me remove this. Look at. If you notice what happened, Nasdaq failed to take out Thursday's low, but US 30 took it out. Another SMT divergence. Look at it. If you go to, let me go to US 30 so that you see. Look at US 30. US 30 took out Thursday's low because there was fair value gap present. The price needed to mitigate. Look at it. There was fair value gap here. You understand? So if you go to 1 hour time frame, look at where you would have taken. I took this trade though. I took this trade on 1 hour time frame. Let me go down to 30 minutes. I took this trade on 15 minutes time frame. So after I saw this liquidity grab, then after I saw this, look at this break of here, this down close candle that is responsible for taking liquidity. After I saw close above it, that was when I took the trade. I made about 1 to 2 or thereabout. I took this trade after I saw this break, or somewhere here was when I took the trade. Put my stop loss below here. Then I was targeting. There was another high I was targeting. Let me go to daily time frame. Okay, that high. But it was Friday, so market couldn't make it. Market couldn't make it. But look at it. If I had left the trade running, the trade now would have gone to my TP. But I closed. Around here when market closed. That was when I closed because it was Friday, so I couldn't hold any longer. If you find this video helpful, don't forget to like, subscribe, and share. Then turn on the bell notification so that whenever I drop videos like this, you'll be first to be notified.